Minute Multipliers, welcome to another session with Larry White. Good to be hanging out with you, buddy.
Always.
The question on the table is this: what in our financials should we be looking at, and how often should we be looking at them? What should we be looking at, and how often? Larry, how would you answer that question?
Well, I would tell everybody that a minimum monthly. You should have a process in place whereby whether you have a bookkeeper, you have an accountant, you've got somebody at a minimum who actually puts together your cash inflows and your outflows so that you can actually see, one, where is the money coming in from, where is the money going, and taking a look at your bottom line cash flow every single month. Because if you're only looking at bank statements, yeah, it looks good, but it's got no predictive nature on what's going on in the future. Like in a prior forecast, a prior part of what we had talked about is forecasting. But what I would say is that's important. The most important thing is actually sitting down and looking at a summarized version of your financial position every single month and discussing it with your controller, your bookkeeper, your CFO, whoever, so that you understand, because really it's a recurring process that needs to occur, because otherwise you're not going to be able to see trends in your business. And usually by the time you realize it, it's too late. And you want to be proactive with how you're running your business and not letting the tail wag the dog, but you need to be in front of it to make sure that once you look at it, you look at your cash flow and you've got the opportunity to at least see a trend, you can make changes on the fly very quickly to make sure that your cash flow is being maintained. And again, monthly is the minimum, and making sure that you have a process to actually sit down, look at it, analyze it, and make sure you understand it so that going forward, you're just securing your cash flow at all times.
Now, to the guy that says, yeah, I look at my P&L every month, but they're not looking at their balance sheet. What would you tell them is the pitfall if they're in that trap of simply looking at QuickBooks and going, yeah, I netted out X and X, but not really taking into account money that they have on the balance sheet, the actual cash balances of the company? What would you say to that guy?
I would say that, learning the balance sheet is not easy. There comes a lot of hard work going through school to actually understand. But here's what I would tell you. A simple rule of thumb is that everything that goes to your P&L is essentially on a timeline. It's really 1 year it's really 1 year's worth of expectation of recognizing either cash or expenses. The things that end up on the balance sheet are the expectation that things are going to be on your balance sheet. They're not going to be recognized in terms of income or expenses, usually greater than a year. So for example, you may have a mortgage. Well, why didn't my mortgage payments end up on my P&L, and why are they on my balance sheet? Well, the reason is probably because they're longer than 1 year. Every time you make a payment, it's considered current, and that ends up on your P&L. So the interest, but you're seeing a reduction in your cash, for example, on a mortgage or a loan on your balance sheet, and something like that payment is not going to occur on your P&L. So you need to truly understand everything that comes out of your balance sheet or reduces your balance sheet. So if it reduces your assets or reduces your receivables or your inventory or whatever, that's really considered an increase in cash. And if you increase your liabilities, that's also considered an increase in cash. So what I would say to you is, when you look at your financials and you look at the monthly, yes, take a look at the balance sheet. Yes, take a look at the profit and loss, but have your bookkeeper, your accountant run what they call a cash flow statement, which will reconcile your P&L to your ending cash. Because I know a lot of people say, well, on my P&L, I made a lot of money, but how come my cash is much less than what I made on my P&L? And the differential is really what's been paid or received into your balance sheet.
Absolutely. So really important to understand and have someone doing a cash flow analysis so you actually get a sense of is the amount of cash I have in the company getting better, or it's dropping because the P&L won't always reflect that, correct?
That is correct.
That's excellent. Larry, enjoyed it. Thanks so much, man, for hanging out once again.
Always.
All right, buddy. Talk to you later.
All right.